Joining us right now is legendary investor Scott Minerd. He is Global Chief Investment Officer at Guggenheim Partners. And Scott, thanks for being here.
Becky, great to be here.
All right, let's talk a little bit about what Paul Tudor Jones had to say. Just that idea that we could be in a position like we were in early 1999, where everything is kind of pointing to an increase in stock prices. You think that's the case?
I think he's right. I tend to look at this as the period after the Asian crisis. The Federal Reserve lowered rates by 75 basis points to save the world. And, of course, then going into 2000, they remained very accommodative, and they kept pushing stocks up into bubble territory. And then, of course, we got the famous internet crash.
I guess the difference now is that rates are incredibly low, 1.5% versus 4.5% like they were back then.
Right, which I think supports higher stock prices in and of itself. And I think, look, with the Fed pivot, I think we've gotten a revival in economic activity. We've got the trade war on hold now. There's a lot of reasons to be positive about the economy for the next 12 months or so. But, I forget who at the Federal Reserve originally said that expansions don't die of old age. Mm-hmm. The Federal Reserve kills them. And so it's just a question about when will the Federal Reserve feel that it has to kill the expansion.
So those were policy mistakes the Fed was making. When you were warning last year about a myriad of things, stock sell-off or a recession or any of those things, that was based on mistakes being made. In hindsight now, those were mistakes. In
2018.
Those were mistakes that the Fed was making then. Did you know they were Fed mistakes at the time, or did you think the Fed was doing the right thing?
Well, Joe, I'm on the advisory committee to the New York Federal Reserve, and I would take data into every meeting, and I would show them how M2 growth was slowing down. I would show them other data in the economy, and I would say to them, I think you're being more restrictive than you think you are. And, the quantitative tightening while the Fed was raising rates was like a double whammy. And so, of course, whenever I brought that point up, all the academics around the table told me how stupid I was.
Well, in hindsight, it made President Trump look like some type of monetary genius for being early and calling out Powell. And we know he's a real estate guy who likes low interest rates, and he's president, so he likes low interest rates. But did it turn out that he actually was more right than the Fed and all the academics?
I think he was. In
crazy
hindsight, he clearly. I think he was more concerned about slowing the economy in his administration.
Right.
But at the end of the day,
all presidents want low rates.
Exactly.
But they're usually not quite as outspoken as he is.
Well, and I think the Fed's going to be, after everything they've just been through and the criticism that they've taken, they're going to be really hesitant to start raising rates again.
Well, that's scary, right? If they should, they should. They should.
Yeah, that's right. And that's why, the stuff I was talking about in risk assets. I mean, when you look at where corporate debt's trading, mm-hmm. The relative premium to treasuries is the narrowest it's been since 1997. Risk assets are priced, or in the bond market at least, are almost priced to perfection. But, of course, bull markets go as long as they go. And as long as the central banks keep the liquidity spigots open, I don't see any reason why we just can't keep pushing asset prices higher.
Your concern, though, when it comes to the corporate bond market is the deterioration just in terms of quality and how many defaults have been there.
Right.
Or increased.
Look, we've had a 50% increase over the last year in the number of defaults. Everybody will point to it and say, well, that were CCC credits, or that was all in energy, or this or that. And, that's to be expected. The weakest links will go first. But, one of the most disturbing things, Becky, is when you look at some of the companies that are rated BBB and even some single A companies that, using the rating agency's own criteria, are already junk. And, how do they do that? They basically argue that, there's a plan to delever. They did this acquisition. They're going to pay down debt. They're going to get the ratios back in line. But, at some point, the music will stop. And all these companies, not everyone is going to get a chair in the musical chairs game. And we're going to find out then, as Warren Buffett famously said, when the tide goes out, we'll find out who's been skinny dipping.
Yeah.
There's a mental image for you.
Yeah. you did say as long as the spigots remain open, things keep working. Do you look at that as half empty or half full? Is it just, is it unjustly going higher, or it's not, or is it the Fed is out of the way in a strong economy, let it run?
Right.
It's not going up on just the balance sheet expansion, is it?
No, not. I mean, that's why I'm more optimistic about stocks than I am about bonds, because when you look at earnings, I mean, I think we're gonna get some pretty good earnings growth this year. I mean, the economy, when you have an unemployment rate this low, you bring in a lot of consumption, especially people that are low-wage workers. They tend to consume 100% of their income. So I think the fundamentals in the economy are actually pretty good. But again, eventually, if there are price pressures, the Fed will feel an obligation to kill the expansion.
Right.